So it's great to be here. Romero had 4 questions. It is the month of Passover. And the Seder dinner, oh, thank you. Seder dinner organized around 4 questions at the Seder dinner organized around the theme, why is this night different? I only have 3 questions. I'm not jealous. From my understanding, the original Talmudic text actually only had 3 questions, and it was later on through tradition added to 4. So I'm going to claim the Seder metaphor because I am going to talk about the suffering of my people. My people being anyone who has to forecast the U.S. economy. And I am going to have something of this theme of why will this year be different than the years that have come before, at least in immediate history. So here are my 3 questions, and they will be familiar from the ones that you heard earlier from all of the speakers. One, what will be the effect of non-monetary policies on the growth rate of the U.S. economy as we go forward through 2018 and into 2019. You may have heard there was this election and a new guy put at the president's office. And I will say one thing, it's been consequential. I won't put any value judgment on that. That's not really my job, but it's been consequential. Second, we have been discussing it in the US as opposed to Argentina for several years. Why is inflation so darn low? You know, sharing circumstances with Japan and the Euro area and other countries. And this may be the year, or I'm going to argue this could be the year that we finally stop talking about that. And then finally, I'm going to turn to this interest rate question that Romero asked and Doug expanded on somewhat, and I will expand on a little bit more. So to the first question. Here's what the Federal Open Market Committee said in December. So the Federal Open Market Committee will about GDP growth in the U.S. 2018, 19, and 20. They will meet in a week and a half, and they will refresh this picture. So the picture may look different now than it did then in the minds of the members of the FOMC. But here's basically the projections that existed as of December. And so the way to read this chart is the black line is just history up to December. The red line is the median projection from all of the people who sat around the table at the last Federal Open Market Committee meeting. These things are known as the Summary of Economic Projections. There isn't one, there's 16 of them at right now. All the presidents and all the governors submit their own. We have no idea who submitted what, by the way, so we don't. So this is basically where the dot charts on interest rates come from, and we don't know whose dot is whose. Even within the committee, they don't know. But the red line is the middle, it's the median. Those dashed bars are the range of opinions, this kind of consensus, central tendency. So you can see, as of December, a time at which tax reform was clearly going to pass, and the form in which it was going to pass was pretty obvious. The median projection for GDP growth in the US economy was 2.5%, trailing off from there. So was a somewhat smaller effect in 2019, an even smaller effect in 2020. So the effects of tax reform on growth in the US at that time were projected to be fairly minimal. I'm going to argue that that was in my view, a pretty good guess at that time, and is still a pretty good guess. And I'm going to take as my evidence what people tell us. I mean, we spend a lot of time at the Fed just talking to people, going out to businesses and asking them formally and informally what their view is of the effect of how tax reform, for example, is going to affect their business. So the formal way we do this is by way of a survey that we run. This is a survey run by the Atlanta Fed in conjunction with Stanford University and the University of Chicago, Booth School at the University of Chicago specifically. And in November, we ask the panel of businesses that we survey the following question. If the Tax Cut and Job Act passes more or less in its current form, how would this affect your capital spending plans going forward into 2018? Okay, and I want to make sure the House of Representatives bill had passed at that point, and in fact, the final bill was very much like what was floating around at the time. So here's what people told us in November. We gave them a choice. You can decrease your capital expenditures by a little or a lot. A little would be less than 10%, a lot more than 10%. You could tell us you're planning to increase your capital expenditures by less than 10% or by more than 10%, or you can tell us it would have no material change on your decisions at all. And you can see the results. 63% basically of the people we surveyed, of the businesses we surveyed, said the tax reform is meaningless to us. It won't change our capital spending plans. All right, that's what they told us in November. So, you know, it wasn't really a reality at that point. By the way, I will also say we did, or the people who run this survey, so I'm not going to take credit for it, my people I work with did a clever thing. They divided the sample in half, and half the people, they just said, suppose tax reform passes in its current form, what will you do? And the other half, they actually gave them specifics about what the Tax Reform Act had in it at that time. And the difference in the responses across those two groups was 0. So people were very aware, businesses in particular, were very aware of what the tax bill, the details of the tax bill. Well, we put this back into the field last month. So, you know, now it's reality, now it's being implemented, and we ask almost exactly the same question again, this time though asking, well, now you've seen the tax cut bill, how is this going to affect your capital spending plans this year? There's the results. More businesses said they weren't going to change their capital spending, their investment expenditure plans than in November. So in some sense, if you're hoping for a big investment boost out of this tax bill, the results got more negative. And interestingly, we broke this down by firm size. Small firms, those less than 99 employees, mid-sized firms, those 100 to 500 employees, and large firms, those with more than 500 employees. And this was the percentage that said they were going to increase their capital expenditures. So the magic red line there is 50%. So less than 50% across the spectrum of business sizes in November said they were going to increase their capital expenditures as a result of tax reform. Okay, the most positive responses came from small businesses. Fast forward to the newest survey from last month, and there's the results. Actually, all that optimism by small businesses went away. So the fraction of small businesses that said that the tax reform was going to cause them to increase investment on plants and equipment and software and all that stuff, that almost halved. And across the spectrum, it's still well less than 50%. So the clear signal we're sort of getting out of this is if you were hoping through the channel of business investment to get a big boost out of tax cut, hold your hopes a bit. We were puzzled kind of why we were getting this result for small businesses who, in prospect of tax reform, were being very optimistic, but in the reality of tax reform became less optimistic, apparently. Why that was the case? Well, here's the result of another survey we took. This is actually from a different survey we run at the Atlanta Fed, and it's just of Southeast businesses. But we basically asked the question, do you think tax reform as a business is going to, money is going to flow to your bottom line? And we broke the results down by legal organization. So on the far left-hand side, C Corps, that's the big corporations. Those are the ones that got the corporate tax cuts. Those other three, S Corps, limited liability companies, sole proprietorships, those are called pass-through entities, if you're not an aficionado of the US tax code, which means their tax rates are tied to the personal income tax code and not the corporate income tax code. So what we saw was the big corporations were, 76% of them said, yeah, this is great. Cash is coming our way. The other groups are not so sure. And in fact, if you run your own business, that's the sole proprietorship thing, well, only 25% of them had any confidence that their tax bills were going to fall as a result of tax reform. They basically don't know. And the gray area in each of these, I'm not sure. I can't really tell you. I'm confused. I don't know what's going on. Well, here's the thing about this. The thing about this is, if you thought, again, if you're thinking in terms of tax reform having an effect on growth, running through a prompting of more investment by businesses in the United States, not clear the place you want most of the money going to is the big businesses who are sitting on piles of cash before tax reform and now are sitting on larger piles of cash. And again, well less than 50% of each of these entities are saying they've got investment plans in place that are increasing as a result of the Tax Reform Act. Reason this is kind of interesting to me is there was an article, an editorial by a guy named Tyler Cohen. I don't know if you read him, but he writes a really great blog called Marginal Revolution. He's a smart guy. And he made a smart observation back in December in Bloomberg Views. The references are sort of cut off, but it was in Bloomberg Views. And he said the following, I'm trying to make sense of Trumponomics. And when I think about Trumponomics and across the entire spectrum of stuff on the table, tax policy, regulatory policy, trade policy, there is a common theme. The common theme is this is a new supply side idea relative to the supply side idea that, like, I learned from the Reagan years back in the 80s. In the Reagan years, the supply side idea was put money in people's pockets. They'll work harder, they'll spend more or save more, that will channel through investment, and that's how you got growth out of tax cuts. The new idea that defines Trumponomics, according to Cohen, is it's about directly putting money into the pockets of corporate entities, of businesses, and directly prompting investment through that channel. Well, the survey results I just showed you suggest that that might not be a great bet. I'm also affiliated, I'm on the board of the National Association of Business Economists in the US, and there is a survey of business members of NABE in the field now, which asks them to kind of rank where they think the tax cuts are going to go when they put more money into people's pockets, and we'll see what that says. But it seems like you would want to make the conjecture that if this is going to be another supply side boost to growth, it's going to work the old way, not the new way. The money is going to go to buybacks, increased dividends, maybe bonuses to workers. That is all putting money back into the pockets of people rather than businesses per se. And if supply side economics is going to work in this context, it's going to be through the old fashioned way. Doesn't look like it's going to happen through this way. One more thing on this survey, we thought maybe we were distorting our view of things by asking businesses only about 2018. So we asked them about 2019, and you can see the results. The green line is the 2018 responses I showed you before. Purple is the 2019, no difference. So they're not telling us they're going to increase business investment expenditures in 2019. They're just telling us they're not going to do it for the most part. Now, turns out that's not the only fiscal policy on the table. Subsequent to the Tax Cut Act, there was a budget bill, which I guess is going to hold. We're in continuing resolution again with a deadline of March 23rd. But the details of the budget resolution are suggesting a fairly sizable increase in spending in the United States. And you can see the numbers there. Additional spending of in 2018 and 19 of $165 billion for defense, $131 billion for non-defense discretionary, and another $89 billion for disaster relief. That's a pretty good bump. And if you were to just mechanically take the spending associated with that and add it to GDP, you'd get 1/3 of a percentage point to 0.4 percentage points in growth in 2018, 2019, both. So would I add that in my own personal view of GDP growth projections? I don't think so, but we'll see. The other wild card, which I don't even have a slide on because it sort of caught me by surprise like everyone else, is of course the tariff issue that has bubbled up in the last week. According to the paper this morning, maybe it was amended to exclude Mexico and Canada. According to the, after the kind of newspaper report, according to the news this morning, well, maybe they're not going to announce anything today and maybe it's going to change, who knows? And that's actually my conclusion. Who knows what's going to happen? I mean, the one thing I think I'm reluctant to do at this point, just from my own personal point of view, and of course I had that disclaimer at the front that if you think I'm representing the Fed, you're thinking wrong. I'm representing my own view here. I'm reluctant to write in too much above 2 to 2.5% that we've seen for some time in the United States now. Turning to the question of inflation, I'll do this one really quick so I can get to the interest rate question. Here, well, this didn't come through so well, but this is, again, the summary of economic projection from the FOMC in December about what's going to happen to inflation. So to the left is reality, to the right is forecast, projections, wishful thinking, who knows, but the view is, and it's my view as well, that going forward, after many years of being below the grass green line, the 2% longer run objective, this will be the year, and next year will be the year that we move towards 2%. And I really kind of mean it. If you look at headline inflation, which is what this is, according to the Fed's favored measure of prices, you can see the fall below the magic line of 2%. That fall actually happens at exactly the time we announced our target was 2%. And we remain on a year-over-year basis below the longer run target. I think this is misleading, though. I'm going to do a trick that if I was sitting in the audience, I would start throwing tomatoes at the person on the stage because I'm going to cherry pick the data and basically show you the 6-month rate. And man, if you look at the 6-month rate, not only are we getting to 2%, we're shooting right through it. But I think this is sort of a legit thing to do, and I'm going to give you a better picture than this. This is core inflation. This is a measure of trend inflation. This is not actually the ex-food and energy. This is the Dallas Fed trimmed mean, which I think, which actually statistically is a better predictor of headline inflation than regular core, and a much better predictor than headline core itself. So I think this, these are fairly reasonable ways to think about what the underlying inflation trend is. And again, the 6-month, right on 2%. Why is the 6 month different than the 12 month? Well, answer is, well, it always is. I mean, that's one answer. But it is the case that 2017 had some unusual events. The most notable one is there was a historically anomalous decline in the price of wireless services as measured, which happened last March. That has depressed the year-over-year number, and the last 6 months have been pretty strong. I'm not gonna, in the interest of time, I'm not gonna show you a bunch of kind of pictures I had after this, but I'll describe the experiment. In September, Janet Yellen gave a speech, and she wrote down what I thought is a very useful model. And the very useful model of inflation decomposes the misses below 2% into the following sources. What can we explain by changes in inflation expectations? What can we explain by slack in the economy, too much unemployment? What can we explain by import prices? So that will be related to the value of the dollar, for example. And what can we explain by a stationary mean zero residual, known to real people as you don't have any idea, do you? So in 2017, the category that explained the miss from 2% on inflation was you don't have any idea, do you? That's okay, it's by construction means zero, so it's gonna go away. And I think that these wireless prices actually were a part. So I'm gonna say that without the usual embarrassment I would have saying that, because I think that these kind of transitory events that we can actually see in the data are largely responsible. The interesting part when that decomposition is the slack, the high unemployment bit, which was dominant explanation for why unemployment fell short, or I mean, inflation fell short of 2% in the period to about 2013 or 14, that's gone away. The US economy is more or less at full employment. And we can argue a little bit one way or the other, but we're close, if not beyond. In the last several years, 2015, 2016, the dominant source of the miss was import prices associated with the very rapid and significant appreciation of the dollar, primarily. That's reversed. And if you, look, I'm from the Fed, we do not forecast exchange rates. We don't talk about exchange rates other than as a purely passive observer with no skin in the game. So take my comments that way. If you listen to commentary about the forces that are going to drive the dollar one way or another, you will hear things like, well, the rest of the economy is gaining steam and catching up to where the United States has been, the rest of the world, and we're primarily talking about Europe at that point. Second, central banks all over the world are beginning their own process of easing back on accommodative monetary policy. That's probably not the right way to put it. They're just going to stop putting in more easing in place going forward. That's the conjecture. Now throw on top of it tariffs, if they arise, and you would get probably most forecasters suggesting, if anything, there will be downward pressure on the dollar, which will mean the reversal of the downward pressure on inflation in the US that existed over the period of time when the dollar was appreciating rapidly. So the economy being roughly at full employment, stimulus maybe coming from fiscal policy, a reversal of many of the downward forces on inflation over the past 6 years suggests to me that at worst, the risks to the inflation scenario are balanced and perhaps even weighted somewhat to the upside. My final question then is about the interest rate bit. And I'll do this quickly so we can get some questions in. But it is apparent that as the Fed started raising rates in earnest, I mean, regularly over the past couple of years, long-term treasuries have risen. And to this issue about MBS and the reversal of the Fed's balance sheet policies, you can see an acceleration in long-term rates. These are Treasury rates, subsequent to the implementation of the normalization, balance sheet normalization process. Because there was a question earlier about it, I kind of threw some slides in here describing what that policy is. And Doug already explained it. It's not really a policy of selling assets. It's a policy of just not, of redeeming, basically expiring or maturing securities on both the MBS side and the Treasury side. And it is a slow process. So it began in the fourth quarter of last year, and there are caps put in place about the maximum amount by which the balance sheet can fall, different caps for MBS and Treasuries. So right now we're at 20 billion a month, ramping up to a maximum of 50 billion a month on a MBS portfolio of over $2 trillion held by the Fed. And that's a maximum. It's going to go slower than that because there's actually the schedule of retiring Treasury securities. The red line there is the caps, and you can see there will be many months when the caps aren't even binding. And with respect to MBS, the caps are never binding going forward unless something unusual happens with redemptions, which, as Doug kind of aptly explained, is kind of unlikely in a rising interest rate environment. There may be some speculative movement early on, but sooner or later, you expect it to slow substantially. So even that slow pace described by those caps is going to be even slower. So is this going to have an effect on interest rates? I think there are arguments that be made for why it may not. And here's quickly what those arguments are. I'm in the group of people, I think it's something of a consensus, who say the large-scale asset purchase programs were effective, but they were more effective early on than they were later on in terms of the bang for the buck. And that was because these things really work when markets are really disrupted and segmented and dislocated, and there are imperfections that could be corrected by asset purchase programs. The pace is slow, as I said. Our footprint, by the way, has gotten smaller as time has gone on. That's particularly true in Treasuries, but true generally as the whole market has gotten bigger. And now look, everybody knows what we're up to. We've been FOMC has been pretty transparent about this. So it's hard to believe that a lot of this, if it is having an effect, isn't already built in. So how do I explain that jump in interest rates post the beginning of balance sheet normalization? Well, there's another event, and that's the one I started out talking about. The real increase in long-term rates began at about the time the president signed the Tax Cuts and Job Act. Subsequent to that, there's been, as I said, even more stimulative policy put in place. I think if we want to conjecture that interest rates are going to rise, there are three places you look: growth, fiscal policy, and imbalances on that side of thing, and the Fed. I think the most consequential is those first two and not the third, but I'm talking my book. So let me stop. Do I have time for a few questions? So, and I'd be glad to answer whatever, or punt on whatever. Yeah.
Thanks, Dave. I have a question about your expectation for the labor market and whether or not you think that there's still slack in the labor market, if you think the labor force participation rate will rise, and what the outlook is for wages.
So I mean, I'm continually surprised by the labor market. We're actually, we'll get a new report tomorrow. If you believe that the ADP is any kind of predictor at all, then it'll be a pretty good report. And it continues to surprise me. I mean, we're running over 170 a month for continually. Replacement rate at constant participation rates is what, 100,000 jobs a month or something? So this is a hot seeming labor market. And it shows no sign of changing, actually. There is an argument, and I think it ought to be considered, that that's telling us there is more slack in the economy than we thought. Labor force participation rates have been flat now for some time. They ought to be going down because of the demographic changes in the economy. The fact that they aren't means that there's more people kind of participating in the labor market each month than is consistent with the long-term trend. Maybe that's a sign that there's more room to run than not, but that's still something of a conjecture. Oh, the wages? Wage growth is roughly in line with 2% inflation and terrible productivity growth. So I don't see that really changing. And it'll get my attention when it does.
Good morning, Professor. I wonder, from some time ago, I wonder myself, what will occur if United States try to make to change the policy and don't recognize and doesn't recognize the debt of the dollar who are out offshore. That is to say, it's very difficult to think like that because it will not occur, I think. But if United States is considered as a country who is in debt with all the world. But on the other hand, I think that most the target of United States could arrive well, could go well. But here we try to imitate or try to think like United States, and it's all the other way around. What do you think about?
So is the question, what are the spillover effects to the rest of the world and how do we account for them? Is that the question?
The question is...
or does the United States policy fit everyone else?
I think that is one... I am economist and try to ask questions about the future or the outlook of the policy of the United States in monetary policy of the United States. In those days, there is the euro also like dollar. But I think trying to imagine what will happen if the United States doesn't recognize the debt offshore.
Well, I wouldn't say we don't recognize it. I think the answer is that there is a long-standing view that if we if we don't do what we think is right for the trajectory of the United States on the inflation front, on the growth front, on all fronts, then we're going to mess everyone else up that way. So, the policymakers themselves are in constant conversation and communication with their counterparts all over the world, and we try not to surprise people and be kind of transparent. And look, there was a time in my career when we felt that the rest of the world didn't matter in a material way for economic consequences in the U.S. Those days are long gone. So, through that channel, factoring in how our policies rebound and feed back to us is always a part of the conversation in the world that exists today.
Thank you. Good conversation, by the way. I was wondering if you could talk a little bit about the other side of the equation, the debt, and the fact that by losing revenue, the United States is increasing its financing needs. And we have seen your comments around the increased spending in defense and other sectors. And how do you see that impacting the creditworthiness of the states as well as the interest rates? Well,
so the creditworthiness problem is a long way off. I mean, much more likely is people will in the rest of the world and in the United States will begin to feel it prudent to, hedge their bets a little bit and diversify their portfolio some. As I said in my comments sort of to this chart, if you're looking for a reason for interest rates to continue their kind of upward trajectory, a good one would be the situation of the federal debt in the United States. And it's on a path that is clearly unsustainable. Something will have to change. And no one appears to have on the table what that change will look like. I'll simply add one other thing about the tariffs. And again, I don't want to make a judgment. I'm not allowed to make a judgment one way or another about the tariffs. I mean, I don't want to, but I'm not allowed to. Not the Fed's portfolio. But I mean, just as a mechanical matter of economics, if you reduce imports, you're also reducing capital flows into the United States and a source of demand for U.S. Treasuries, and that through that channel as well would put upward pressure on interest rates. So I think that's the thing to watch. Not expecting any big breakout of growth. I think the interest rate pressures, the dominant story is the fiscal deficit.
Well, thank you, David, for your presentation.